Manufacturing at a crossroads. February 2025 PMI report signals slowing growth amid rising pressures. The U.S. manufacturing sector continued to expand in February 2025, marking the second consecutive month of growth after over 2 years of contraction. However, the latest manufacturing PMI registered trademark, released by the Institute for Supply Management, reveals a more complex picture beneath the headline number. At 50.3, February's PMI reading is lower than January's 50.9, indicating that while the sector remains in expansion, the momentum is weakening. This subtle decline raises important questions about the sustainability of the recovery, especially as rising costs, slowing demand, and policy uncertainty create new challenges for manufacturers. One of the most concerning elements of the February report is the sharp drop in new orders, which fell from 55.1 in January to 48.6, signaling a contraction in incoming demand. This is a critical indicator, as new orders serve as a leading measure of future production activity.
Breaking news.
The reversal into contraction territory suggests that businesses may be pulling back on spending due to economic uncertainty, higher input costs, and concerns over tariffs. Meanwhile, production remains in expansion but at a slower pace. The production index for February came in at 50.7, down from 52.5 in January. Although still above the critical 50-point threshold, the decline suggests that manufacturers are adjusting their output levels in response to weaker demand signals. Companies appear cautious about ramping up production too quickly, preferring to wait for clearer signs of market stability before making significant operational commitments. Another major shift in February was the return of employment to contraction. The employment index fell to 47.6 from 50.3, highlighting a renewed wave of labor reductions across the manufacturing sector. Many companies continue to rely on attrition-based downsizing rather than outright layoffs, signaling a strategic approach to cost control. Despite the recent expansion in manufacturing activity, businesses remain hesitant to increase headcounts amid uncertain demand conditions and rising operational costs. This drop in employment suggests that manufacturers do not yet have the confidence to scale up their workforce. It also raises broader concerns about labor market trends, as a weakening manufacturing job market could spill over into other sectors of the economy. One of the most striking elements of the February report is the shift in supplier deliveries and prices, both of which indicate increasing pressure on supply chains. The Supplier Deliveries Index rose to 54.5, up from 50.9, indicating that delivery times are slowing. Typically, slower deliveries are associated with higher demand, but in this case, the trend appears to be driven more by logistical disruptions and tariff-related complications. Typically, slower deliveries are associated with higher demand, but in this case, the trend appears to be driven more by logistical disruptions and tariff-related complications. Prices, on the other hand, surged dramatically. The prices index jumped to 62.4, a significant increase from 54.9 in January. This acceleration in price growth is largely attributed to commodity price inflation, particularly in steel, aluminum, plastics, and energy costs. With the introduction of new trade tariffs set for mid-March, manufacturers are already seeing higher material costs, leading to price increases that will eventually filter down to consumers. International trade remains a key area of concern for manufacturers. New export orders slowed slightly, coming in at 51.4 compared to 52.4 in January. While still in expansion territory, the decline suggests that global demand for U.S. manufactured goods may be losing strength. Meanwhile, imports continued their positive trend, rising to 52.6 from 51.1 in January. This uptick suggests that manufacturers are bringing in more raw materials, likely in anticipation of impending tariff changes. Companies are working to secure inventory ahead of potential cost increases, adding another layer of complexity to supply chain management. Manufacturers' inventories remain in slight contraction, registering 49.9 in February, though this is an improvement from 45.9 in January. This suggests that businesses are maintaining a lean inventory strategy, likely due to cost concerns and uncertainty about future demand. Meanwhile, backlogs of orders, though still contracting, showed some improvement at 46.8, up from 44.9. This means that while companies are working through existing orders at a faster pace, there is still not enough new demand to significantly replenish order books. Key takeaways. What to watch moving forward. The manufacturing sector is currently at a critical inflection point. The biggest variables moving forward will be tariff implementation, Federal Reserve policy decisions, and shifts in business and consumer confidence. If demand remains soft and cost pressures continue to rise, manufacturing could slide back into contraction in the coming months. At the same time, inflation remains a key concern. The jump in commodity prices suggests that businesses may pass costs on to consumers, potentially complicating the Fed's efforts to manage inflation expectations. Higher prices, coupled with slowing job growth in manufacturing, could have broader implications for overall economic activity. As we move into the second quarter of 2025, all eyes will be on whether demand rebounds or if this slowdown deepens. For businesses, investors, and policymakers, this month's PMI report serves as a warning sign, one that should not be ignored.